Our next guest sees some big opportunities in certain areas within that sector. Joining us now is Fort Pitt Capital CIO Dan I. Dan, so you like Thermo Fisher, you like Danaher. Why those in particular?
Yeah, happy Friday, and thanks for having me. Both of these companies were just huge beneficiaries of COVID, related testing and vaccine revenues. And to put that into context, Thermo's earnings per share were up, 75% in 2020 and another 22% in 2021. So obviously, that demand is rolling off. The pharmaceutical customers that they serve are working through excess inventory levels, and some of the smaller biotech companies that they serve are kind of feeling the pinch for tighter liquidity. But we view those as very short-term issues that have frankly been very well expected and even telegraphed. And just longer term, these businesses have very durable growth profiles with exposure to very attractive end markets, such as biopharma processing, diagnostics, as well as life sciences tools. And what we really like is very sticky and very visible, highly visible revenue streams. Both companies generate about 75% of their revenue from recurring sources.
So how do you feel about medical technology in general, the likes of Boston Scientific or Medtronic, and then pharmaceutical names, perhaps on the other side? We've been talking quite a bit about some of those lately.
Yeah. So we really do like the pharmaceutical sector, especially the well-established large cap pharmaceutical companies that generate, extremely attractive free cash flow profiles, offer investors really attractive dividends, have rock solid balance sheets. They're growing their earnings at high single digits, and the stocks are very cheap. The pharmaceutical companies that we focus on are trading at, call it 8 to 12 times earnings, which we look at as extremely attractive and undervalued.
So, Dan, we had Oaktree. We have news that Oaktree is also, raising a $2 billion plus private credit fund that is going to be dedicated to life sciences. When you see developments like this, is that a positive for the overall sector, or is that a sign that maybe this is a trade that could potentially get crowded quickly?
No, I think it's generally positive. What we're seeing right now is, the two companies that I mentioned and focus on, these are trading at 10 to 15% valuation discounts compared to their 5-year averages. So the sector is certainly not overheated, but they're probably seeing the same thing that we see is these companies have very durable growth profiles. Call it low to mid low teens type of earnings growth. Valuations are attractive, and again, they have very visible revenue and earnings stream. So I definitely don't see it as a sign that the sector is anywhere close to overheated.